everyone! In our previous lecture, we discussed the remarkable rise of China and its growing influence on the global economic landscape. Today, we are shifting our focus to another pivotal event that has a lasting impact on the global economy, the 2008 global financial crisis. The perfect storm. The GFC was not a single event, but a confluence of factors that created a perfect storm in the financial markets. Some of the key contributing factors included housing bubble. In the United States, easy credit conditions and lax lending standards fueled a speculative bubble in the housing market. Home prices soared to unsustainable levels, and many borrowers took on mortgages that they couldn't afford. Financial deregulation. The financial sector had become increasingly deregulated in the preceding decades, allowing banks and other financial institutions to engage in risky activities with little oversight. Complex financial instruments. The rise of complex financial instruments, such as mortgage-backed securities and collateralized debt obligations, made it difficult to assess the true risk underlying these investments. Global interconnectedness. The globalization of financial markets meant that problems in one country could quickly spread to others, amplifying the impact of the crisis. The unraveling. When the housing bubble burst in 2007, it set off a chain reaction that quickly spread throughout the global financial system. Mortgage delinquencies and foreclosures soared, leading to massive losses for banks and other financial institutions. Credit markets froze as lenders became reluctant to lend to each other or to businesses and consumers. Stock markets plunged, wiping out trillions of dollars in wealth. Global trade plummeted as businesses struggled to obtain financing and consumer demand collapsed. The GFC was the worst financial crisis since the Great Depression of the 1930s. It caused widespread economic hardship, including rising unemployment, bankruptcies, and home foreclosures. The aftermath. The GFC led to a major rethinking of financial regulation and economic policy. Governments around the world took steps to strengthen oversight of financial institutions, impose stricter capital requirements, and curb excessive risk-taking. The crisis also sparked a debate about the role of globalization in the financial system. Some argued that globalization had exacerbated the crisis by allowing risky financial practices to spread across the borders. Others argued that globalization had helped to mitigate the crisis by providing a source of capital and liquidity when domestic markets froze. Lessons learned. The GFC taught us several important lessons about the risk and fragility of the global financial system. It highlighted the need for prudent regulation. Effective regulation is essential to prevent excessive risk-taking and ensure the stability of financial markets. Transparency. Greater transparency is needed to understand the complex risk embedded in financial instruments and prevent hidden risk from building up. International cooperation. Global financial crises require global solutions. Countries need to cooperate to strengthen financial regulation, prevent financial contagion, and manage the economic fallout of crisis. The road ahead. The GFC has left a lasting legacy on the global economy. It has reshaped financial markets, economic policy, and even our understanding of risk and uncertainty. While the global economy has largely recovered from the crisis, its scars remain. The challenge for policymakers and financial institutions is to learn from the mistakes of the past and build a more resilient and sustainable financial system for the future.